Earnings season is starting to wind down. And if you've been keeping track, as of November 19th, 84% of S&P 500 companies reported actual earnings per share that were above estimates, albeit the bar was already lowered. Let's talk about it now with Jordan Stuart, Client Portfolio Manager at Federated Hermes. Jordan, good to see you. So we're almost done here with the plethora of earnings. How would you characterize earnings season this time around?
Yeah, so we're starting to see some improvement. The companies, the value companies, call them airlines and hotel companies that have been hit the hardest during the pandemic, are starting to show some improvements in the sense of cost controls, slowing the cash bleed. Businesses are less bad than they were as the third quarter showed, less and less lockdowns, and this economic recovery has been accelerating from here. However, our take is even today, you're starting to see the rotation shift back. Is longer term as we look into 2021. The shift is good for now, but does it continue if lockdowns, as we're seeing today, pick back up? Issues, as the last gentleman who was on talking about potential food shortages or issues, lines in grocery stores in New York. Companies that we own in the growth sectors have the visibility, have the sustainability for their earnings, and don't have to worry about so much of the macro environment, which is so uncertain, whether it's, again, DC or it could be, additional lockdowns, issues with the vaccine. And this thing's going to take some time to recover. And the outlook for the growth companies that have secular tailwinds just have kind of a longer, more sustainable trajectory.
Not every company is able to look out and offer guidance because things are so uncertain right now. But the companies that have been offering that guidance, it's been mostly positive. One would think they would only share guidance if it was positive. But do you think that they're being a little too optimistic, Jordan?
Yeah, that's a good point. So a lot of companies are beating earnings because they haven't provided guidance, and the estimates have been dropped lower and lower as the quarters have gone on, and a lot of companies still don't have guidance into 2021. I think that the bar is getting higher for companies that have that guidance. It's tough to beat a comp where you were up 100% last year if your business was open or you were online, right? But I think that the market is starting to price that in. The growth stocks are very expensive relative to value stocks because they can control, for the most part, their own destiny. And some of the value stocks, again, they have no visibility and very little visibility. So that I think that's caused a lot of investors to stay with the growth stocks that have that visibility, even if the guidance is aggressive. I'd rather grow at 90% versus 100% guidance next year versus negative or 0% flat earnings for the following year. So I think the market's interesting. It's very efficient, and that guidance could come down a little bit. But again, those companies are in a better situation than the other companies in the value side. Mm-hmm.
If companies come out and say, earnings, if we go into major lockdown across the country again, are analysts just going to have to, and companies alike, reassess these earnings estimates, and are things going to have to get a lot lowered?
Yeah, I think a lot of costs have been taken out. So I think this is kind of why we question the trajectory into 2021 is because they have not added that capacity back. Airlines are not adding planes, adding lanes and shifts. So I think the most of the cost that could be taken out has been taken out so far. So I think it's the companies that can grow during the work from home environment, that can benefit from the e-commerce, the pandemic stocks, if you will, are going to be well suited into 2021 and 2022 if this lingers and continues, which from our perspective, you talk to the average CFO, CEO, they're not interested in investing next year or hiring or picking up, adding additional capacity. And in that case, it's going to be software companies, biotech companies that have that trajectory.
What's your forecast for earnings? I don't know if you have an annual one for all of 21, or are you at least looking at Q1 of next year?
Look, we don't have a formal forecast, but we do expect the trajectory to continue to improve. But that all could change. If these lockdowns persist, if we have a weak holiday season this year, I think there's been a dispersion in economies, if you will. The online companies are going to continue to do really well. If you have a brick and mortar store, I think you're going to struggle. So I think everyone has earnings, but they have that eraser ready to go for the next year. Because if these persist, and as we look at the euphoria around the vaccine, now we're into a risky part of the distribution and execution. As your guest 2 guests ago said, there's still going to be a lot of people that aren't going to have access to this in the next 6 months. Some people will hesitate to take the vaccine. Right now we've seen it is effective at 95%, which is outstanding. But this could take some time. And again, it's just that hesitant march forward for investors and CFOs alike to continue to put capital to work. And that's going to cause the economy to have fits and starts.
Yep. And the eraser is not far behind. Jordan Stuart, Client Portfolio Manager at Federated Hermes. Thanks for being with us.
Thanks, Alex.